You are watching a paradox. On July 28th, HYBE posted the biggest quarter any K-pop company has ever recorded. 1.45 trillion won, nearly $1 billion in 90 days. And then, inside 24 hours, investors erased almost $2 billion off its market value. You're watching the exact moment BTS proved 7 people can double a multi-billion-dollar company. And the exact moment the market punished HYBE for how they did it. This isn't an abstract number for executives in Seoul. It decides what you pay for a ticket, how hard merchandise gets pushed at you on Weverse, and which artists on that roster get funded next. So, if you want to understand why the market panicked, you have to stop reading headlines and read the line items. Because HYBE's second quarter breakdown has a structural problem buried in it that the press release never mentions. Start with the split. HYBE sorts everything into 2 buckets. Direct involvement is recorded music, concerts, advertising, appearances, anything that needs the artist to physically show up. Indirect is merchandise, licensing, content, and the fan platform. Direct involvement revenue hit 1.04 trillion won. That's 72% of the entire quarter, up 132% year over year. Concerts on their own brought in 647.7 billion won, up 243%. In May alone, BTS grossed $127.8 million across 12 shows and moved 641,000 tickets. No group has posted a bigger month since Billboard launched its Top Tours chart in 1919. Not the Rolling Stones, nobody. And the stock still fell 16%. Here's what almost nobody explained. That record touring number is exactly what caused it. Touring is the lowest margin money HYBE makes. Stadium rent, freight, staging, crew, local promoters, artist settlements. All of it gets paid before HYBE keeps a single won. A Weverse membership costs almost nothing to reproduce. A world tour does not, so the mix matters more than the total. Operating expenses doubled to roughly 1.3 trillion won. Operating profit came in at 170.9 billion. On 1.45 trillion in sales, that's an 11.8% margin. And HYBE told analysts directly that gross margin fell from the previous quarter on concert costs. Brokerages had modeled a high margin quarter led by merchandise. What they got was a lower margin quarter led by tickets. HYBE fell 16.09% on the Korea exchange. Worst day since June 2022. Then it kept sliding the next session, down to its lowest level since September 2024. Now this is where HYBE's structure actually matters, and where most coverage gets it wrong. HYBE doesn't control ticketing in every market. What it controls is everything after the ticket. The label, the distribution, the merchandise, the membership, and the platform. All of it runs through the same company. Which means the album isn't really the product. The album is the acquisition cost for a fan who then subscribes and buys and stays inside an ecosystem HYBE owns end to end. That's the bet, and in the second quarter, the bet paid. Weverse hit 14.43 million monthly active users. All-time high, up 8% quarter over quarter, with revenue per paying user up 24% in a single quarter. But the real question isn't why a record quarter crashed the stock. It's what HYBE has already scheduled for the back half of this year, and why the analysts on that call kept circling the same year. HYBE staged 119 shows in the first half of 2026. It has more than 200 planned for the second half, nearly double the volume in the same number of months. Ask yourself who physically absorbs that. The brokerages that stayed positive all named the same fix. More merchandise production in the second half, plus touring from Cordis and Katsaye, which is another way of saying the margin only recovers if the high margin layer catches up to the tour. Recorded music revenue reached 326.8 billion won, up 43%, carried by Arirang, released March 20th. Best-selling vinyl in the United States for the first half of the year. Best-selling CD too. 7 people, back from military service, doubling a company's revenue in 90 days. And HYBE spent the entire earnings call arguing that isn't the story. 5 of the 10 best-selling CDs in the United States in the first half came from HYBE artists. Cordis and Cat's Eye are already contributing to profit. Korea climbed to 3rd worldwide in music exports. Management's answer to the sustainability question was diversification. Analysts asked it anyway, repeatedly, pressing on growth drivers beyond 2027. on competition in North America, and then the stock fell 16%. That's the market grading the answer. So the monopoly framing you'll see in other videos is wrong, and it's wrong in an interesting way. HYBE doesn't have pricing power over global touring. Universal, Sony, and every Korean rival are competing for the same stadiums and the same fans. What HYBE has is a fan platform that turns a tour into recurring revenue better than anyone else has managed. That's a real structural advantage. It's also a fragile one, because it needs a tour to convert. So, which is it? Did HYBE build an ecosystem that survives without BTS? Or did this quarter just prove that 7 people are still carrying the entire company? To see what happens when a company does control the ticketing layer and why that turned into a federal antitrust case in the United States, watch this breakdown next.